Well, hello everyone, and welcome back to Saylor Academy's NBA 601 Financial Management. This is going to be the assessment review. This will be part one. Obviously, we've gone through every episode of every week. We've gone through every unit of the course and done these videos. So if you haven't watched those yet, you should definitely go back. And of course, these videos are supplemental to the course themselves, so you should definitely check out the course. All of that is linked in the description below. If you're watching later, feel free to leave a comment down there as well. If you're watching right now, you can leave us a question in a chat, and we'll get to it. But I'm just going to hand it over to Dr. Lou Pearsall to get us going, and I'll get out of the way.
Thanks, Michael. And again, welcome back, everyone. This is a review. We've actually gone through and done a review of each of the units that were contained in our course. There are 7 units, and we've talked at length about each one and discussed. And if you've been watching, you know that our courses are designed around some stated learning objectives. And each week in the presentation, I've referenced the particular objective that applied to a unit. Here's 4. I'm not going to go through during the reviews, but there were 8 learning objectives, and I believe you'll find that throughout the course, we have in fact identified, addressed, and related to each of these objectives. The basis of this course is really a recognition and an understanding of the validity and the need to do financial analysis in your business. All right, and simply put, when we're looking at financial performance, we're going to look at 3 things. We want to see, how did you do? And so we review the past. We take a history lesson in past performance. We're keenly interested in how you're doing today. And so as a former executive of a company, I wanted to know how we were progressing right now at this point in time against the plan that we went into the year with. And last, you're going to be thinking about where you want this business to go. Well, no surprise that a good part of these discussions, a good part of these reviews are going to go back to the numbers. We say that at the end of the day, business is about numbers. The language of business is numbers. And hopefully we've conveyed that during these past presentations. I'm going to take us back for a minute to Unit 2 in the course, where we focused a lot on financial ratios. And I'm sure you saw a number of ratios, probably too many ratios. And what I can tell you is that with all the ratios that we covered in this course, there are more. And so why? What's the value? They're bits of information that help management focus on where there might be a need to take corrective action, where there might be a need to do more of, where we might have to make some decisions. So there's lots of analysis going around ratios. And we're going to talk a little bit about that in the first part of the assessment. We also mentioned that when you're doing financial analysis, we're doing a number of things. We're doing a comparative financial analysis. What are we comparing? We're comparing yesterday with today. Or we're looking at what we're doing today and comparing it with where we want to go for next year. So we're evaluating. This is a moving plan. It's dynamic. Finance is dynamic in business today. We're going to consider trends. And a trend says, on a simple basis, is our trend for sales going up? Have we flattened, or are sales declining? So we want to look at trends. Trends have a value in helping us determine where we want to focus some of our time and efforts. And we're going to do some benchmarking, which means that it's not enough to sit here and exist in my own little world with my own business to really determine how well we're doing, or if there are opportunities to do better. We want to compare what we're doing. We want to benchmark against other people in our industry. How do we compare in sales or in inventory issues compared to some of our major competitors in the industry? Now, we started all of this going back by taking a look at the basic financial statement of a business. This is a simple income statement. And note that the income statement, which basically shows how much came in, how much went out, and is there anything left? In this case, it's categorized. We're breaking those things down so that we can get a better idea of where we might want to focus attention. So yes, we have product sales, but we're going to make sure that we focus on what the cost of goods sold. And remember that cost of goods is labor and materials, and that results in a gross margin. So given the sales, after we take out what we spent for labor and materials, what was left? What's left is now going to be applied to a bunch of other categories because that's not the only expense category of the business. So then we'll look at SG&A, selling general administrative expenses, all the other expenses in operating our company, which will give us our earnings. But we're going to look at earnings now before we pay out any interest, any taxes, any depreciation, any amortization, or in other words, EBITDA. Then we're going to take out depreciation. And remember, depreciation is we're using up assets. We bought a piece of equipment 2 years ago. It's not worth the same now. Why? Because it's 2 years older. We've depreciated part of that expense. So let's take that depreciation out. Now we have earnings before income taxes. So make sure that we pay our taxes. Absolutely. We'll take out our taxes. And what's left is our net earnings or the bottom line or profit. That's what you've made out of your sales when everything else has been accounted for. We also want to make sure that we look at the balance sheet, certainly of interest to investors. And the balance sheet, if you recall, has current assets on one side of the balance sheet, which are all the things that we own. Now, current assets are those assets that can be turned into cash in a year or less. We also have long-term assets, typically property, plant, and equipment. And on the right-hand side, we have liabilities or things that we owe. And again, like assets, we have current liabilities, things that have to be paid in the next 12 months, and some non-current liabilities, long-term debt, a 20-year mortgage. And the difference between assets and liabilities is, of course, shareholders' equity. That's what the owners have when all is said and done. If the assets were liquidated and the liabilities were paid off, is there anything left for you, the owner of the firm? And that's shareholders' equity. Now, having said that, what we're going to do today and next week is I'm going to take the opportunity to review a little bit about an assessment. As in all courses, once you've taken the course and read the material and completed the assignments, we want to be able to assess what have you learned as a result of this course. Call it a final exam, a test, a practice exam, or an assessment. It's assessing the fact that we hope that you've got the information that we tried to present to you, and you're able to apply that information. Now, I'm going to break the assessment down into two parts. This week, we're going to talk about part one, and we're going to go back to one of your favorite topics, which is financial ratios. Because it is so important in the analysis of our financial condition, we need to be aware of what they are, how they're calculated, and what they mean to the business. So that's going to be part one. So we're going to go through and I'll review the way these questions might appear, mostly multiple choice, and we'll chat a little bit about each one. Next week, we'll go to part two. And part two of the assessment will probably spend a bit more time on talking about understanding and application of financial principles. Okay, so let's get started. And just to note, what I've done here is there's a simple income statement and balance sheet that will appear on the slide. That's basically when we're doing financial analysis, this is what we refer to. And there's going to be a question. And so our first question is going to be recognition of the gross margin. It measures the impact of a firm's cost of goods sold. So what is the gross margin? And so in this case, what we are going to do is we are going to take a look at two things. We're going to take a look at what were the sales and what was the margin after accounting for cost of goods sold. And so you'll see down in the left-hand corner that the formula for calculating gross margin is simply taking the gross margin and dividing it by sales. And the result here is that the gross margin is 35.2%. So what does that mean? It means that out of sales of $3.4 million, 35% was left for gross margin. That was the impact of cost of goods sold. Now, a lot of things that you can tell from this, and I'm not going to go back and repeat all the things we covered in our course, but just remember, there's only two numbers here, sales and cost of goods sold, that have an impact on this ratio. So if you want this number to be higher, which I expect you do, you can do a couple things. You can keep cost of goods sold as the same and generate more sales. That will increase the gross margin ratio. Or you can keep sales the same and you can reduce the cost of goods sold, negotiate better agreements with your suppliers and vendors. That will increase the gross margin percent. Or you can follow one of Pearsall's rules, which is do both. Increase sales, reduce cost of goods sold, and make even more money. Okay, so this is a typical question in the first part of the assessment. And so let's just go through a few more. Let's talk about the current ratio. And if I can bring you back into the course, what is the current ratio? Well, the current ratio is going to ask us to look at assets and liabilities. But we're going to look at the current assets, not all assets. And we're going to look at the current liabilities. In other words, this is a measure of liquidity, right? Because current assets are the ones that can be turned to cash within 12 months. Current liabilities are due within that same 12-month period. So what is the current ratio of assets to liabilities? In this case, we're going to take a look at those current assets. We're going to divide it by the current liabilities, and we get a current ratio of 2.9. Great. What does that mean? Well, it does tell us something. It says that for every dollar that we have in liabilities or money that you own, you have almost 3 times that in assets. In other words, you have almost 3 times the assets available to cover the liabilities. Now, is that good or bad? I don't know. This is just a snapshot in a moment in time. We might want to see what it has been over the past number of months, or what's been forecast, or what's expected as a current ratio in your industry. It may be something that's higher. This may be fine. So as in all things, these give you a number, which is but the beginning of your task, because your real task is to understand the story behind the numbers. What does this mean for your business? What does it mean for your shareholders? Let's take a look at return on assets, one of my favorites. One of the things that the business does is you take in money from owners and shareholders. What do you do with that? Well, you invest it. You invest in assets that will generate sales for your products and services, and that will create a business that's generating a return on investments. So we might want to know, what is the return on the assets that you've invested in? And that's return on assets. And for that, we're going to look at net earnings. Again, what were the earnings that were generated, and the total assets. Remember, total assets, all the things that the firm owns because you spent money from owners and shareholders to buy this. And so our return on assets in this case is 33.1%. Again, good, bad, it depends. What we know is that we have total assets of $1.4 million. Based on the use of those assets, we were able to generate almost $500,000 in earnings. So we received a 33.1% return. What I might be looking for as an investor is, one, is that a reasonable return given this business and this industry at this time? And two, when we go back and we look historically, or we look at the trend, are we showing a trend that maybe this is increasing year over year? That would be a good sign that management is doing a reasonably good job of getting the right assets and using it to generate earnings for shareholders and owners. What about return on equity? Now, remember that equity is the amount of money that the owners and the shareholders have in the business. If that business were to be liquidated today, what do the owners walk away with? That's equity. Well, the return on equity, again, is going to look at what are the net earnings that the business has earned, and what is that total shareholders' equity. Note, by the way, that we're using both the income statement and the balance sheet. And as we get further into this, or as you get further into analyzing your business, remember that there are other parts of the financial statements that you're going to be using. Making it simple, we're focusing simply on income statement and balance sheet today. So in this case, we're going to take the net earnings that the business earned. We're going to divide that by shareholders' equity, and we're going to get what's the return on equity. In this case, the return is almost 80%. I mean, net earnings are almost $500,000, and shareholders' equity is 600,000. So it shows how much return are you making based on the equity that is in the business. It's another measurement of use of equity or not using equity. And again, whether or not you're happy and pleased with 79% depends on a number of additional factors, including what else is going on in the industry and how does this fare for businesses and competition in the marketplace. Let's take a look at inventory turns. This has always been one of my favorites. If you are a business that has to maintain an inventory of your product for sale, if you're in retail, if you're Walmart, if you're Target, if you're any major retail operation, you have inventory. The inventory is a balancing act. Inventory costs money. All right. If you're a manufacturer like I was back in my time with Carrier Air Conditioning Company, we manufactured air conditioning and heating units. We had manufacturing facilities around the world building product. Question is, yes, I have to have inventory so that they're available for sale, but how much inventory? Remember, every unit that we produced and I put on a shelf cost money. It costs money to buy the parts and materials, costs money for labor, costs money to operate the manufacturing facility. It's costing money for the distribution center, the overhead, the rent, the insurance. Inventory is an expense. It's controllable. And how do you control inventory? What do we want to look at? We want to try to get and have no more inventory that is necessary to really support the requirements of our customers. In an ideal world, I would have one unit on the shelf. I would put it on the shelf today and somebody would buy it this afternoon. I would be maintaining no inventory. And what amazing impact on cost that will be. But that's not reasonable. What we do want to do is we want to make sure that our inventory is at an appropriate level. And one way to do that is by looking at inventory turns. So in this case, we're going to look at the cost of goods sold. Remember, the cost of goods sold is that materials and labor to build the products. And we're going to look at the inventory that's sitting in the shelf. Now, inventory is an asset. It's something we own. But the real value of inventory, of course, is when it's sold and it generates revenue. So if we look at the cost of goods sold and we divide it by the inventory, we come up with inventory turns. In this case, it's 2.83. Now, what does that mean? That means over the course of a year, we are going to fill up the warehouse, sell the material, and we're going to do that 2.8 times. So we are turning the inventory almost 3 times a year. Now, again, what's the right inventory turn number? Depends on your business, depends on the product, depends on the production cycle. I will tell you this. Back in my time as a director of materials for a manufacturing firm, folks planning inventory, part of their compensation and incentive package was in increasing the number of inventory turns year over year. In other words, find ways to reduce the amount of inventory you're carrying so you're turning it faster and we're not consuming and spending all of that money prior to a sale. By the way, this is one of the things that by analyzing this and looking at this, companies started working with close and critical suppliers and came up with programs like just in time. I mean, what is just in time inventory? It's inventory that arrives at the door to your manufacturing facility the day it's needed to go into production. So you've eliminated storage and carrying that inventory. So there's a real benefit to digging into the numbers and understanding what they're doing. We make decisions based on this. And in some cases, we start involving suppliers and even customers and trying to find out ways to make ourselves better, more effective, and more proficient. Now, at this point, I'm going to take a quick break and see if anybody has any questions.
Well, of course, I got my eye on the chat right now. If anyone has any questions, they can put them in the chat. And of course, if you're watching later, feel free to put them down in the comment section below, and we'll get to them if we can. I'm not seeing any questions right now, though. If someone in the chat would like to come up with some sort of game around Pearsall's rules, I would enjoy that. I think that. I think people watching could come up with with a Pearsall rules drinking game or something like that. They're all good rules.
Well, number one, I bet they would, and number two, I always thought they were good. And that's
Is that number one and number two of Pearsall's numbers? The second Pearsall's rule is Pearsall thinks his rules are pretty good.
Seriously, they're serious. This is finance is serious stuff, but it's also fun.
Yep.
Okay, so seeing no questions or comments, let me go on here, and let's talk about the debt to equity ratio. Now, remember, when we were talking about debt and equity, talking about the capital plan, one of the things that the company does is we recognize that the capital plan has two major components. One is debt, money that we borrow from outside lenders. And the other is equity, using that equity, that owner's equity that's in the business. And we have a pool of debt and equity to come up with the amount of capital we need to make critical investments, new plants, new equipment, new facility. One way to see how well we're doing with debt to equity is to look at the debt to equity ratio. And for that, we're simply going to take a look at total liabilities, and we're going to look at what that shareholders' equity is. So when I look at total liabilities and shareholders' equity, I see that the debt to equity ratio is 1.3. Now, what's that mean? It means that for every dollar in equity, I have $1.3 in debt. Now, remember that we talked, or I hope that you remember, we discussed a bit that using debt is a good thing in business. We call it leverage. We're leveraging other people's money to generate a return. And as you increase the amount of debt, you increase the return on equity to owners. Why? Because the return is going up, or the return is the same, but you're using less of their money. As in all things, the downside to having too much liability is risk. And it's the risk of default, the risk that the firm won't be able to meet their obligations to repay the debt. And of course, that can lead to really adverse activities like bankruptcy. So debt to equity, one of the major ratios we want to use when we're looking at how is the firm making decisions on capital. Let's consider the fixed asset turnover ratio. Now, big word, but before we go further, let me just stop and mention fixed assets. What are they? Well, fixed assets are those things like plant, property, and equipment. They're fixed because you buy a facility, you build a manufacturing plant. That asset isn't going to go anywhere. You're going to be using that. It's a fixed asset. However, also recognize that on these assets are recorded at acquisition price. So, for example, if you bought a piece of equipment at $100,000, you record that as $100,000 in assets. But 5 years later, is that still worth $100,000? No, it's 5 years older. You've been using it, or you've been consuming that asset. And we call that depreciation. And so we count the depreciation. We keep track of how the equipment is in fact depreciating. So for our fixed asset turnover ratio, we're going to look at sales, because how much sales were generated as a result of the investment in fixed assets. Note that we're looking at net fixed assets or net property, plant, and equipment. Why is that important? Because that's the value of those assets today, all right, after we've taken out the depreciation. Now, just a note, one thing that an investor or a potential investor can look at when looking at the balance sheet is what the net property, plant, and equipment is. For example, if you know that a firm bought a piece of equipment for $100,000, they purchased that piece of equipment 5 years ago, and after depreciation, the value of that piece of equipment is now $10,000. That tells you something. It tells us, one, that the company's been using that asset to create revenue, but it also tells you that there's probably not too long before it's going to be necessary for the firm to make another capital investment, right? That equipment may need to be replaced. So again, we look at the numbers are the numbers. What's the story behind the numbers? What is it telling us? Now, in this case, we take net sales, we divide it by the net fixed assets, and we have a fixed asset turnover of 10.4. In other words, for every dollar that was invested in those fixed assets, you've got $10.4 in net sales. All right. Is it a good ratio? Depends. As in all things, additional analysis and research is required. Let's take a look at the total asset turnover now, because now we're gonna expand the scope. Let's look at all the assets, not just the fixed assets. And so what are we going to do? We're going to take net sales, and this time we're going to take the total assets available. And the total asset turnover is 2.3. Now, obviously, this is lower than the fixed asset turnover because the asset number is bigger. But you are still generating $3.4 million in sales with $1.4 million that you invested in assets. So there's a 2.3 turnover rate. One thing that that I would look at as a shareholder, or I would be looking at as the president and CEO of a business, is what are we doing to make sure that the assets we're acquiring are exactly the ones we need to generate an appropriate amount of sales for the business? I mean, is it possible to invest too much in assets? Sure. Suppose you, in your planning, you determined that you could dramatically improve sales. You bought a second facility and the sales plan didn't work. You're going to have a substantial amount of assets, excuse me, on the balance sheet with not a big improvement, excuse me, in the sales number to show for those assets. Remember, going back to the responsibility of management to make decisions that are in the best interest of shareholders and owners. And this is one of the things that we'll be looking at to determine that. Basic earning power is an interesting ratio. And the basic earning power wants to know, given the assets of the firm, how is that having an impact on revenue? But we don't want to consider the extraordinary expenses of like interest payments and taxes. So what we're going to do for this ratio is we're going to look at EBIT. Back on the income statement, EBIT, the earnings before we have paid out any interest and any taxes. Remember, interest and taxes are a function of financing and decisions that the business has made. That's not the revenue being generated just by operating the business. That would be EBIT. So let's take EBIT and divide it by total assets. And in this case, our basic earning power is 59.2%. That EBIT, after taking out cost of goods sold and SG&A of $800,000 based on total assets of $1.4 million, has a basic earning power of 59.2%. Again, one more method, one more grade to give to the executives of this business in evaluating how well they're doing in making decisions. They made decisions in acquiring assets. Are we seeing the result in the revenue that's being generated through using those assets? Another thing that we would be interested in looking, especially in days like today, where there are issues with inflation and the economy, and it's a global issue, is accounts receivable days. In other words, we're selling goods, and in most cases, we're not selling them for cash, but customers are buying on credit. You buy a product, you're going to get an invoice, and the invoice should be paid in 30 days. Well, a critical question for the management team is, how well are those invoices being paid? You can imagine that as the economy gets tougher, that it may take people longer to perhaps pay those invoices that are due. That extends out the number of days that you are sitting there with accounts receivable. Now, before we get to the ratio, let me just step back and remind you that accounts receivables is an asset. It's right there on the balance sheet under assets. It's something that the firm owns. That's money that is due us. If we have accounts receivable of $1 million, we're considering that an asset. However, recognize that that's an asset if it gets paid. If it doesn't get paid, it becomes a write-off, it becomes a liability, and it has a negative impact on the business. So companies will pay attention to the accounts receivable and how well it's being turned. Remember, it has a direct impact on cash flow. If I have a substantial amount of money out there that's due to the firm through accounts receivable, and I'm not collecting it, I may have to use equity or take out a short-term note to cover day-to-day operating expenses. So one of the things that we'll look at is the accounts receivable day, which says, let's take a look at what those accounts receivable are and what were the overall sales. And we're going to multiply that by 365 days a year. In this case, our accounts receivable days is 31.6. Now, if the sales terms are invoices are paid in net 30, then we're not doing too bad. If our invoices or our terms were payable in 10 days, then we're running over. And in my experience from my business, one of the things that I got on a monthly basis was a statement of accounts receivable days broken down by what was current, what was 30 to 60 days, what was 60 to 90 days, what was over 90 days. At some point, you're going to have to make a determination on the likelihood of you actually collecting a receivable that's way overdue. Two things have to happen. One, you're going to have to exercise additional time and resources and money to try and collect the debt. Or worst case, you'll have to write the debt off. And again, that's the negative impact. So paying attention to accounts receivable days is one of the keys to being aware and managing what's taking place in your business. This has been a short overview of some of these ratios. I mean, you know, from the course, there's a lot more, and there are many more that we didn't cover. We will use ratios and we'll identify ratios that we want to capture based on our analysis of what's taking place in the business, where we might need to focus some attention. What are some things that we might have to address or spend some time and resources on? Now, having said that, there's a couple of keys to success here. If I were looking to coach you on addressing an assessment at this stage on these things like financial ratios, what would you do? Well, I think, first of all, make sure that you familiarize yourself with the financial package. And it goes back to something we've said throughout these lectures, which is that the financial package is essential information for management and for investors and potential investors. You need to understand what the numbers are, where they go. We get financials can come on a weekly, a monthly, a quarterly, an annual basis. So this information is coming in, but they're only useful if you're able to pick up that package and go through each of the statements and you know what you're looking for, you know what it represents. And one thing that I mentioned early on in our course was that although like for today's review, we looked at the income statement and the balance sheet, Um, which one of these statements is more important, the most important? All of them. The reason why we have a financial package consisting of these statements is that they all tell us something different. They all give us a unique perspective about what's going on in the business. Review the various financial ratios. There is tons of material, both of going back and looking at some of our previous videos online. Lots has been said about financial ratios, calculating them, and more importantly for me is understanding what they mean. What do you get out of it? So take the opportunity to practice calculating some of these financial ratios. Go back and look at the question before you turn to the answer page in this lecture. Can you calculate those ratios? Next week, I'll do an assessment, a review of the assessment part 2, which I said no calculations, which may be good or bad, but more discussion on application of basic financial principles and what they mean to the management of a company and to the shareholders. And with that, I'll turn it back to Michael.
All right. Well, as always, thank you so much, Dr. Pearsall. We do not. I'm not seeing any questions in the chat right now, but if you have them, feel free to leave them. I know sometimes when we do exam reviews, you understand it right when it is explained, and then you might have a question later. Like once you go back. So of course, go back and watch. But if you have a question, you can leave it later in the comment section, and we can get to it next week if as you're thinking about it over the week, something comes to you. But I want to thank everyone for joining us. Again, thank you, Dr. Pearsall, for taking us through this. And so same time next week, we'll go through the final exam. And again, if you've just been watching this and maybe it was confusing to you, maybe go back and check out the course and check out the previous videos we did. Because again, these are all overviews of the course that is on Saylor Academy and linked below. But again, I think that was a pretty good closing vamp, and I'm not seeing any questions in the chat. So everybody, again, thank you so much for joining us. Again, thank you, Dr. Pearsall, for going through this, and we will see you all this same time next week.
Thanks, Michael. Thanks, everybody, for watching.